Our guest says anxiety has hit the markets, and although valuations are starting to look attractive, there probably is more downside risk. Let's get more from Sadiq Adatia, Chief Investment Officer at BMO Global Asset Management. Sadiq, great to see you.
Thanks for having me.
So there's a tariff fear, you think, permeating the markets right now?
Yeah, I think all through this year, people have forgotten, the uncertainty that Trump was going to bring to the markets. So at the beginning of the year, we highlight to clients that, there likely would be some rotation in the markets. The unpredictable nature of Trump would require to have hedges in place. Things like gold would do quite well, which has transpired. And the other part of it is that this was not going to be a couple of months situation. This was going to be a much longer situation. And we're starting to see that play out in the markets. And therefore, right now, investors are quite nervous. They're anxious as to what might happen and how they're going to play out the rest of the year, given the uncertainty that's out there.
Even if the tariffs are brutal tomorrow, it could be something of a relief in that people would know what they are, at least.
Yeah, I think that's another important point, is that companies don't know how to plan ahead because they don't know what a tariff's going to look like, how their input costs are going to play out, what consumers are going to be willing to spend. Once they have some certainty, they can put some projections out there, and clients can also do the same thing on evaluating stocks. So once we can get that number, and again, it's not, in my opinion, not going to be zero, you can put that into the valuation models and you can get to a point where you say, okay, a company X is now worth Y, given what's going on with the tariffs.
You do see downside risk, though. You think there could be more selling here?
I think there has to be. I mean, the key here is that consumers are reacting to the tariff situation. Whether it's going to be 10, 15, 20, 25, they are going to react. They're going to tighten up their belts a little bit. We're going to see savings rates go up, and that means spending has to decrease. And if spending's decreased, that means companies, revenues must come down, GDP numbers must come down. And that could eventually lead to further layoffs in the markets as well. So there's a reactionary impact that's going to occur. It's kind of a domino effect. And to me, stocks are priced in, the uncertainty, but they haven't priced in the actual outcome yet. So there is probably room for further downside here. But I do think there are names that are looking attractive.
You are underweight Canada, though, right now.
We are underweight Canada because I think Canada's actually getting the brunt of this at the moment. Go back a year ago, would you have thought Canada would be at the forefront of the tariff discussions? We wouldn't have thought that, right? I think China would have been the first. Yeah, exactly right. So that part was not priced into the Canada's economy. And then the uncertainty on the election front is another thing we have to be careful about. But overall, I do think that, we're getting closer to the point where, Canada will start to look like a bit more of a value play compared to other segments of the markets, including the Canadian dollar.
U.S. markets, the big question is Trump and his team, how long will they be happy to see stocks under pressure?
Yeah, you would have thought that he would have been, the pain point would have been already, over 10%. It could be much higher from here now. You've gotten this far. Do you stop at this stage if you're Trump? I think the key point is, does he know where the end game actually is going to be? And I don't know if he does. I think it's reactionary as each month goes by. And so it's hard to predict, what that's going to look like. But I do think from the standpoint of, the tariff situation in the U.S. economy, the U.S. is going to get hit by this as well. And I think, the Trump administration is not factoring that in quite well. And the markets are. And therefore, you're seeing the U.S. market, which had the highest valuations, getting hit the hardest as a result of that. And that's probably fair. But in the long run, eventually markets are going to come back to the fundamentals. And again, back to your earlier point, if we get some certainty on what the tariffs are going to look like, then you can value things correctly.
They certainly seem to be thinking big, the U.S. administration. We've heard talk of a remodeling of the U.S. economy. The thing like that takes decades, though.
It does. And I think what Trump is trying to do at the moment is trying to be a little bit more forceful on things, right? So kind of having the upper hand on strongest economy, coming through with, most of the exports are coming to the U.S. So therefore, leveraging that, including the defense that's going on in Europe, all of that combined is giving them the ability to push hard on everything that's going on today. And, if we think out, this is his, 4 years term that he has, but in a couple of years from now, right, when we get the Senate and Congress kind of back on track again and coming up for their votes, he really has to get a lot of these things done within the next couple of years. And so that's the pressure of him trying to get things done quicker. And we haven't got the positive parts of the market, which really is, tax cuts and more deregulation, which should be more positive for the second half of the year than the first half.
That's interesting, but those apparent benefits will take a while to emerge.
They will, but once they're announced, I think the market then shifts away from the tariff situation to the positive angles of potentially the Trump administration. But again, we don't know how long the tariff situation is going to last and the uncertainty that it's going to have over the markets.
Are you in the camp that European stocks look decent right now?
I think European stocks look undervalued still, even despite the run-up. The momentum is in the right direction. I wouldn't call it a growth engine by any means. It's not the U.S. 2 years ago by any means. But I think given the uncertainty around what's going on with the U.S. and valuations, I think Europe looks a little bit more attractive. And this is part of our story of a bit of a rotation. You want to move out of the growthier names in the U.S. to some of the value segments, to some of the areas like China and international markets, because those have been beaten up a little bit more than the U.S. over the last few years. So it's time to be better diversified than just focusing on just the Mag 7, for instance.
What assets are you increasing in your model portfolios? Are you increasing cash or are you increasing bonds?
Yeah, so we've been increasing our bond allocation. We're still underweight cash and we're neutral on equities. And the reason that we're increasing our allocations to bonds is predominantly because we think the uncertainty that's out there is definitely going to be beneficial to bonds. We're not ruling out rate cuts in Canada and the US, which should be beneficial as well. And then we've increased our commodity exposure. So we're overweight, gold particularly. We've had that overweight since 2023. One of the best positions that we've had within our portfolio is protected, but also giving you good upside returns on top of that as well. And it's been one of the better hedges against the uncertainty that we're seeing in the Trump administration.
Are you inclined to lighten up on gold now that it's gone so high?
We've taken some profits, but we're still overweight. So we were very, very bullish, and now we're bullish. Again, until we get some certainty on that, again, the tariff situation and a bit more of a game plan of where the Trump administration is going to go, I think you still want to own gold for that uncertainty. Once we get a little bit of that played out, then I think you can start lightening up on your gold positioning and move back into the equity world.
Sadiq, thanks very much.
Thanks for having me.